let me start the webinar. Good day to one and all. This is Dr. Sivaraman of analysing.com. During the early part of the European session, I presented Tracking the Forex Market Together Part 1. And in continuation of it, I am going to present Part 2 of the webinar. And I've been explaining with regard to the simple market tracking technique and also effective trading strategy to earn consistently from that of the market. So I will also explain that during this particular webinar time. So this webinar I give once a month, and this consists of two parts, Part 1 and Part 2. Part 1, I take the positions and then I try to show the results of the Part 1 during that of the Part 2, so that people will be able to understand how we can take such quick trading decisions and thereby we are able to make consistent profit. Now, during that of the Part 1, I took the position in the case of Euro, a sell position, even though I was telling you that it was after that drop, but since they have been holding below that of the initial low for more than 30 minutes, and they are likely to make further downward move. So that is what I took a sell position, and I was able to close it around 12:30 GMT when they made the final drop and around 35.38, and just using a trailing stop and tighten it and just close it with a profit because the swing was very less on the downside. So I decided to close it. And also similarly, in the case of GBP, they made the downward move from the top that 67.97 to the top 67.64, and then subsequently I took profit around 67.70 and 27 pips profit was booked. And in the case of USD CAD, I took a buy position around because the initial high was 1.0909 and they were staying above that. So I took a buy position and kept the sell stop at 1.0876, but they've been holding it and they went only up to that of 1.0919 and then simply holding around in a narrow range. And that is the main reason that I always say that once the spread becomes more than 40 pips between the high and the low, if you take a position, then you'll be able to quickly book profit. So this is a standing example here. And also I kept another sell order just about 12 pips above that of the market in the case of Euro Yen, and 138.86 when it was around 138.74, but it was not filled. So such a low volume swings are seen in the market. And so only two trades I took and both were booked with a profit. The other one I'm holding it. And definitely during this particular session, they will make the rise in the case of USD CAD, and then I'll be able to book a nominal profit because the way in which they are handling it as a contrarian move in the case of USD CAD as well as Australian dollar, both are showing positive net change. They may make only subdued moves. They may not make any big move during this particular US session. Now, let me just show you the forecast to start with. And before that, so in this market tracking technique, first of all, I use the forecast derived with the help of the algorithm. Then afterwards, I fine-tune the forecast using the market reading. The market reading technique, I explained it during that of the Part 1 also. I can explain it again in a brief way. And those who are interested to know elaborately the Part 1 can probably go to fxtrade.com, and in that you will find under the webinar, the recorded webinar is being displayed. Tracking the Forex Market Together Part 1 is being displayed. You click there, you'll be able to listen to that webinar. And then you can understand the Part 2 is also going to be recorded, and you can listen to Part 2 also in case if you want to get an elaborate explanation with regard to my trading strategies. Still, if you got the doubt, you can always contact me. My contact details I'll be giving at the end. You are free to contact me without any strings attached to that. Then market reading is this technique. We use it by noting down the initial lows and the highs around 3:30 GMT in four majors and two commodity pairs, and try to use that as a reference level for that of the day, and try to find out using in the live market code page where exactly they are staying, whether they are near that of the high or near that of the low or below the low or above the high. And from time to time, we just relate it and find out what sort of moves they are doing it in the market. So that according to the type of moves, we'll be able to take positions. Now, we need to follow the market using the timings followed by that of the players. So the players have divided the market into three sessions: Japanese, European, and US, or session 1, 2, and 3. And the session timings are given here. In between, you come across the gap time. And these gap times are nothing but the time left when most of the European banks and the Asian banks, when they close the official trading, and the US banks, when they start, there is a naturally occurring 30 minutes time frame. And during that time, you will not come across any big orders coming in the market. And the players make use of that, and then they try to place some big orders to hit the stops. And those times are referred as a gap time. These are all the timings followed by that of the players. So don't ask me what is the logic behind it. And that is the logic that when the banks open and when they start doing the trades, the early sessions, the players also try to accommodate and try to make the moves in such a way that they earn at every moment. So each session is subdivided into early, mid, and the late sessions. And the early and the late sessions, they handle the majors, and the mid sessions, they handle the crosses. So if you want to trade crosses, then you wait for the mid session so that they will make quick moves. Then you can take positions in them. And I have given some of the informations how exactly the early, late sessions and mid sessions gap times are being defined. And always look into that the spread between the high and the low is made more than 40 pips in the case of major, and more than 70 pips in the case of the crosses. Only then, if you try to take the positions, you will be able to quickly book profit in such currencies. Otherwise, it may just test your patience. So you can use the live market code page. The link is also given here. If you want, I'll give the link. So these are all the market timings, and now we are in the gap time. 13 to 13:45 GMT is the webinar schedule, and so we are at this particular gap time. So gap time moves or false move. So let us just gap time moves or false move. We will see what sort of moves they are doing it now. So after noting down the initial lows and the highs, we try to compare it with it of the current lows and the highs and current market level, so that we try to understand what they are trying to do it. So I'll just refer it to that of the initial lows and the highs set around 3:30 GMT, which I noted down during the Japanese session. And now I compared it during the European session to that market. Now I will compare it with that of the US session market. Now Euro is around 1.3542, and when I was giving the part 1, it was around 3555, and they just made during start of the European session an upward stop and briefly on the upside, and then subsequently made the slide, and the initial low is 1.3587, and they have been holding below that for more than 2 hours. I told you that they are doing the intentional move on the downside. So they will not reverse it. They just started after the upward stop, and they started the intentional move, a slow slide during that of the European session. Now the European session is over. Now the gap time, they are making a small coming up move, and afterwards they will make a small swing during the early part of the US session, and then continue to make the downward move. Now, if you refer to the forecast, what I have given it, for 10th of June, they're expected to make a swing and firm up move during that of the US session. And that is the forecast for derivation. But when you look into that of the market reading, we try to understand that they are doing the intentional move. So the intentional move, the European session they started, then they will continue with that of the US session, and towards close of the US session, they may firm up a little bit from that of the new low, and that will be the second session. Then the third session, tomorrow Japanese session, they will make one quick downward stop and then reverse. So you'll find the dip during that of the Japanese session. So you may not come across a big firming up move. That is how we fine-tune the forecast. So they are expected to make the swing and slide and small firm up, and then just induce the last minute short sellers. And also they try to sell more tomorrow during the Japanese session, make a downward move and hit the stops of those who have taken the long position initially and kept stops around 75 pips to 100 pips away, and then hit their stops and buy, and afterwards they start making the firming up move. So this we need to understand. This is the way the fine-tuning of the forecast happens. Hope you are able to understand now. Then in the case of GBP, it is just when during the European session, it was around 1.68 area, and then it breached 1.6784 soon after the webinar is over, and then subsequently found that they came down to 1.6766 and they have breached it during the gap time again, and they are expected to make a small firm up and then continue to make the slide in the case of GBP also. And you find now that during the early part of the European session, Euro negative net change was more when compared to that of GBP, and now you find almost equal. Then in the case of Yen, they just breached the initial low 102.35 and came down to 102.22. Still, they are not breached it. Even though they are holding around 102.24, they are not breached the low. At the same time, they went above that of 102.35 after 2 hours during the later part of the European session, stayed above there, and now only they started making the slide again. So this is nothing but an extended move on the downside, and it is not an intentional move on the downside in the case of USD-Yen. So it is unlikely to make a big drop. So Euro and GBP are expected to continue to slide during that of the US session. Then CHF. 89.70 is the low. They just breached and formed a new low and started recovering. And then 89.74 is the high. They just breached the initial high and staying above that. So they are expected to continue to make an upward move above that of 0.9008. So one can do a small buy and sell trade in the case of USD CHF. And in the case of Canadian dollar, that 101.0901 is the low, initial low. And during the early part of the European session, they came below that 1.0891 as a downward stop and then started gaining the level. And all along, they have been holding above that of 1.0909. And then they came down below and subsequently went up to that of one. Then I took a buy position at 1.0914, and then they went only about 5 pips above and started making the slide. They are just doing a consolidation here to make an upward move in the case of USD CAD. And also they are handling the commodity crosses by showing the contrarian move. USD CAD is showing positive net change, as well as AUD is also showing positive net change. And in the case of AUD, there you have seen just towards close of the European session, they made one brief upward stop, and then 0.9341 was the low that is not reached, whereas 93.63 was the low. Then during the early part of the European session, they made one upward stop in 93.76 and came down. And they came closer to that other low, but not reached the low, and again went up, and then just made another new high, 93.84 from 93.76, and come below that of 93.76. That was the earlier high. So they are just briefly doing about 10 to 12 pips upward stop. And in the case of Aussie, and during part one, and somebody was asking the question, when Aussie is going to drop? So it shows very clearly that the players are testing the patience of the traders and trying to induce them to do the short covering. And so that is what effectively happened. So now we have compared the market, and you find that Euro, they are holding near that of the low, and also USDN near low, and also GBP near low. And all are showing negative net change of contrarian move in order to make a downward move in the case of Euro EN and GBBN. That is what I was trying to take a sell and then try to book profit. And it was around 35 pips negative net change, and now it has become 84 pips negative net change. And GBBN also, they just from 28 pips, they just made it to 83 pips. So now we are able to understand whenever they make the contrarian move, we should take positions in the case of crosses. And when they are making the USD gaining or the USD weakening move, then we have to calmly focus on that of the majors. Then only we'll be able to earn from that of the market. Now let me explain to you, for those who have not come to the part 1 of the webinar, the type of moves. Because this is the most important thing. So in market reading, first of all, we need to note down the timings of the market. So in market reading, we try to find out that what time it is, whether it is a gap time or the US session, European or Japanese session. Then this market, we track it using the GM2 time frame, a 24 hours market cycle, because market is 24 hours on. So from Monday to Friday, 24 hours, and you come across the day change happens during the gap time from 2030. US session gets over by 2030. From 2030 to 0030, you find the gap time wherein the bank orders do not flow. Then the players make some quick moves on the upside or the downside. You come across most of the stop-ins happen during that. And also the interest rate is being calculated for the pending positions, and that is added to the other positions later on in the platform. So you find it is a 24 hours market. In this 24 hours market, we need to find out following the timings. That is from the session start. So either Japanese or the European or the US session. In first 30 minutes during the early session, they make one quick upward or a quick downward stop and above that of the initial high or below that of the initial low. And this is normal cheating behavior of the players. So what they do is they just pretend as if the market is going to fall and then rise. Pretend as if the market is going to rise and then drop. And during that of the early part of the European session, you would have noticed that they pretended as if euro is to go to 1.3668 again, like yesterday. It just breached and gone above that of 1.36 and did not sustain there for more than 10 minutes and started making the slide. So it is the normal custom for the players to hit the stops and then reverse. Hit the stops and then reverse. So that is why the traders, when they take positions, they avoid keeping the stop. But sometimes what happens, they make an extended move for 30, 40 pips or sometimes 60 pips on the upside. See, for the non-farm payroll, for example, they just quickly went up about 50 pips from that of 1.3635 to 1.3678. So when they make such extended move on the upside, then we should be in a position to sustain. We should not become afraid. And those who trade without a stop, just because the stop is being filled by that of the players very frequently, they avoid keeping stop, but they become more frightful. So they invariably become restless and ask so many people, the market is against my positions, what is going to happen, and things like that. And instead of becoming perturbed, the best way to trade in the market is control your addictness to trade. So how it can be done? You just wait for the start of the session. You know very well they are going to make an upward stop and or a downward stop. And okay. Then afterwards, the opposite, they are going to do it. So don't take any position. Wait up to 8 GMT. That is 7:30 GMT, the European session starts. And 8 GMT, when they just make an upward move and a stop and stop cutting the new high for 10 minutes, then take a sell position. 10 to 30 minutes, then take a sell position. keep 30 pips hedge order so that during the downward swing, you'll be able to definitely book profit. So all the quick moves in the market, like a stop and or a false move or an extended move, are all just misguiding moves or a false move. So any quick upward move, if you think that market has suddenly turned bullish, then it is wrong. They quickly gain the level without making much of a buy in the market. So what happens? So when euro is around 1.3500 on Friday, Thursday, when ECB press meet was there, they came down quickly to 1.35 and then sustained there for only about 2-3 minutes and then gained to 1.3540 level. So what happens at that time when the traders think that, okay, that news is bad, so we have to take sell and buy trade because it is not going up. When the traders sell, they absorb all the position. Afterwards, they keep 1.3580 sell and they buy it. And another 1.3600 and buy it. Then immediately what happens? The market comes to 1.36. So in between, the traders hardly keep any higher level sell orders unless and otherwise a person is position trader. He does not keep the limit order. Most of the traders have got a tendency that let it go there, then I'll book profit at the market. Many of the traders have got the tendency to take the position at market and also close it at market. They don't keep the take profit order or they don't just keep a limit order to enter into that other market. So there won't be much of an orders when they quickly gain about 50-60 pips. And what the players do, they buy their own orders and make it as a trade. Then the market goes up. Then after gaining without making much of a buy, when they gain the levels, they hold high and start selling. But we all become bullish and try to buy it from them. See how a cunning strategy it is. So all the quick moves on the upside or on the downside or false move, they quickly drop in order to buy. When the traders sell in distress, the long positions, they're thinking that no, euro is going to collapse further down. So it is better to exit out of that. They exit out of the positions and later on the players buy all and then gain the levels. So if they make the intentional move, then understand it is a slow move on the downside. That means they wanted to make further downward move. If they quickly gain upward the move, then it is a false move. So you should be able to understand that all the quick moves are false moves. And the players quickly make the moves in order to exit out of the positions at a higher level. Similarly, to enter into the position at the lower level. So that we need to understand. It is not that we try to do a contrarian trade or something like that. This is what the players do it. So we need to know the trick of the trade and try to accommodate ourselves and trade in line with that of their market moves. Then we find consistently along with them, we are also making profit. So that is how we have to differentiate that of the stop and the false move. False move is the one they come up to that of the high. In the case of GBP today, they came up to that of the high without breaching the high. They came down the initial high. That is the false move. And the extended move, as I explained in the case of yen, they just did it. They just breached the initial low 102.35 and came below to 102.22, and they are still holding it and they are not breaching it again and again. It is an extended move, and then they went up above that of 102.35 and stayed there. And again, now they have come below and they wanted to go up again. So it's not like the intentional move here, what you come across in the case of euro. And intentional move is the one wherein you come across this slow pip by pip drop. Whereas the extended move is the one which will be one quick drop and afterwards stop cutting the new high. So differentiate the moves, then you find that you are able to really read the market. And you will not become perturbed or you will not become nervous once you understand. And during the mid sessions, they will only make the swings between the high and the low or swing near that of the high, near that of the low. So unless and otherwise you are interested in crosses, then better just take it leisurely during that of the mid sessions and come back during that of the late session, you'll be able to see definite profit in those positions. So take the position during the early part of the session and close it by late session. Again, next session, you try to watch what they are trying to do it. If it is an intentional move started from that of the European session, then understand they will continue till European US session and continue during the start of the Japanese session tomorrow. So during quick downward move tomorrow, when they form the new low and stop cutting the new low, then try to take a buy position. We'll be able to book profit when they are slowly gaining the level as an extended move, because the intentional move will be alternated with that of the extended move. Because the players don't do any hat trick. That is, they don't make similar moves for more than 2 sessions. They don't make similar moves for more than 2 days, more than 2 weeks, more than 2 months. Only then they will be able to pretend as if the market is going to follow a rhythm and just reverse and then give an opposite move. And that is why you come across many people who find that, okay, there is a pattern in the market. This is the pattern by which they are making the moves. You follow it for a day, follow it for the second day, the third day, it disappears. It makes a different move. Similarly, they try to correlate the markets. Okay, now Dow Jones can be compared with that of Euro, or sometimes Dow Jones can be compared with that of Yen, and Nikkei can be compared with that of Yen, and so many correlations. Because if you see the chart pattern, both the charts might look similar. So immediately we find that, okay, they are correlated. Then you just follow it for 2-3 days, then you find they differ. Then we can calculate the correlation coefficient and say that, okay, the correlation is lesser now and the correlation is more with another chart. What is a big deal in it? So every time you will come across some sort of similarities. Even if you see the type of human being, the human races, all the human races in the world are human, but you will come across variation among the races. And what is a big deal in studying about the variations in the races? Unless and otherwise, you are going to do the anthropology studies. Otherwise, we simply comparing the chart of one with another, which are not at all related and which are not at all operated by in a similar pattern. Then by identifying the coincidences as correlations, then they are all going to be misguiding factors. So what I am trying to tell you is not I'm trying to criticize. You need to follow the players, because the men trade against men. It is not God is trying to trade against us. It is men, a group of men who are wealthy, who are powerful with their money, and they will be able to dictate terms in the world. And such people are making the moves in the market. But so those people, even though they have got enormous power, they can only show it against the small traders and all the other institutions, because only there, if they show, they will be able to earn money. Just because they have got the money power, if they just construct a big castle with gold and stay there, and they are not going to be earning anything. And they have to invest their money in the market. And that invested money has to multiply. They cannot afford to take any sort of risk, because if they take a risk, then they may not hold the slots like number 1 in the world and number 2 in the world. They may miss it. So what they do is they don't take any atom of chance, and they don't take any risk-free trades. They do it with the informations from all angles, and then they try to earn money from the other market. And simply people can say that market cannot be manipulated and it is a huge market and things like that. And such people also, when they see such erratic moves happen, immediately the big players, they use the terms. And I remember that in 1999, 2000, 2001, when I was giving the terminology to the operators, many people were telling that the market is huge, nobody can operate in it. And later on, I find that many people started using the terms players, because they find that moves are erratic and they are not logically explainable, because only then the traders become victim of such moves. once the traders become victim of such moves, then the traders lose the money and the players earn the money. So it is a process by which the players try to continue to earn from that of the traders. So what is more important for us to understand our limitations, because we cannot afford to take unlimited positions. Within our usable margin, we should be able to take positions and protect our positions without getting the margin call. And we are afraid of keeping the stop. In such a scenario, use the hedge order to limit the risk. And once we use the hedge order 30 pips away from the market, we can find out that whether the hedging is making profit or not, or if it is hedged and the hedging is making profit or not. If it is not making profit, understand it was filled during stop and or a false move or an extended move, and close it with a nominal loss of 1 or 2 pips, or just stop at entry and keep another 10, 20 pips or 30 pips away, another hedge order, and try to move it closer to the original buy position or a sell position, then keep stop at entry and remove the hedge order. So in such a way that what happens, the hedging act instead of a stop. And hedging can be used to reverse the trade also. Just in case if it is hedged and the hedging is consistently making profit, you just close the sell position and book profit on the buy side. So that way you will be able to reverse the trade. And also the hedging can give you either way trading opportunities. When they just make a drop, you try to keep stop at entry and trail that stop in the profit making position and book profit and keep another hedge order below that. And when they start gaining the levels, then you trail the hedging order upward until you are able to keep stop at entry on the buy side and book profit on the buy side as well. Because in the market, you come across both the buyers as well as the sellers. So the buyers also make profit, sellers also make profit. And there's a saying that even though the market is bearish, that all the sellers may not make money. Even though the market is bullish, all the buyers may not make money. Because if you try to buy after the rise, even in a bullish market, you will not be able to earn. If you sell after the drop, even in a bearish market, you will not be able to earn. So ultimately, what is more important is what is visible in the market is not true. If the market looks bearish and if the market is closer to that of the low, then don't try to sell. If the market is near that of the high, then don't try to buy. So many of the traders think that, okay, the breakout trades are the safest trade. And so last year and the year before, many of the traders were focusing only on breakout trades. And you know that many of the analysts were also recommending only the breakout trades. And later on, they find that nearly 90% of the occasions, they were only false breakout. They just quickly make an upward stop and then reverse, or quickly make a downward stop and then reverse. In such a situation, they all started recommending that don't go in for breakout trade, because many of the times they are making false breakout. So ultimately, the players try to see that whatever way the traders commit the positions, it is not what the traders are publishing in the websites or in the various media and things like that. And what way the traders commit positions, the institutions commit positions, then they try to create the market feel. That is, they create the market sentiment. And then later on, everybody commits the position. Then you find that they simply reverse the market using some attribute. So the attribute can change from time to time. If there is no specific attribute, they can simply create a rumor and also reverse the market. So they got all the tools with them. So it is not that we have to follow the technicals and the fundamentals so that we'll be able to consistently earn. No. They got another tool called rumor. So that rumor, we won't be knowing when they are going to release it. So the only way is protect the positions using the entry stop or buy stop or the sell stop, so that you are really limiting the risk to only 30 pips. Because as soon as you take the position in the market, we are forced to take the risk, because there is a spread between the bid and the ask. So if I try to sell here, then my position will be showing 1 or 2 pips loss. If I try to take a buy position here, my position will be showing 1 or 2 pips loss. So any position as soon as you take, it will be showing loss. And then subsequently, you have to keep the hedge order to limit the risk 30 pips away from that of the entry. And once a position makes profit, you can keep stop at the entry. Now, with regard to the market reading for that of the gap time, it did not come across much of a swing here. They just made a brief downward stop in the case of Euro, downward stop in the case of GBP, and an upward stop in the case of Aussie. And also they just came down a little bit in the case of Canadian dollar. So no significant move. They had done it in all the currencies during that of the gap time. So now, during that of the session start, the session starts by 13:30 GMT. So 13:30 onwards up to 14 GMT is the early part, the first 30 minutes. In the first 30 minutes, if they make a downward stop and you try to take a buy, if they make an upward stop and you try to take a sell. But as we have studied that already they had done the intentional move on the downside in the case of Euro and GBP. So when they have done the intentional move, it is not going to reverse the next session. So they will be reversing only on the third session. So we will not do buy and sell trade in the case of Euro and GBP. We will only do sell and buy trade, but try to sell slightly higher, probably around 1.3552 or 53 level in the case of Euro. When they show it, we can take a sell. I'm not taking a fresh sell position here. Because now the market is in a slow phase, and around 14 GMT we can take a sell position, but the gap time is over, and in the first 15 minutes I will not be able to take any positions. I have to watch up to 14 GMT. Only then I'll be able to commit a position when they are firming up a little bit and try to take a sell position, because I want to teach you the right method instead of, for the webinar sake, I just taken during the European session, even though it was the end of the early part of the early European session. Still, I took after the drop a sell position in the case of Euro. But the best way is during the stop and during the first 30 minutes of the session, 7:30 to 8, when they are making an upward move, if you try to take sell position, we'll be able to make a substantial profit, about 60-70 pips profit on that particular trade. But since after the drop, I took a sell position because I know very well it was an intentional move. That is why I was able to book 17 pips profit. Otherwise, sell after the drop is not advisable. But if you identify the type of moves they are doing it, then you can do it. So now we need to identify how they are continuing with regard to the moves here. Then we can continue the positions or take the positions. As such, I have only the CAD position. So I got a buy position at 1.0914 with a sell stop at 0.876. So that position I continue with regard to that of the US session. And when they make a small firm up around 14 GMT, you can just take a sell position. What they do is they try to come up to that of the initial low. You just keep the note of the initial low. When they come closer to that of 35.87, probably they may come up to 35.70 or 35.75 by 14 GMT and then start reversing it. So that the pullback, that is what people used to call it as the pullback before making further drop. But actually what the players do is they try to make a quick gain up to that initial low or closer to that. And sometimes they go above that in order to confuse the traders, but they don't stay more than 30 minutes above the initial low in the event if there is a data release, etc. then they don't stay above that of the initial low for more than 30 minutes. In 5-10 minutes, they reverse again. That means it is a false upward move in order to make for the downward move. This, they do it because after the drop, what happens? The traders avoid committing positions. So when the traders avoid committing positions, in order to trigger the traders to commit position, what they do is they quickly make an upward move so that the traders think that, okay, it is going to rise. Then they jump and later on they drop and induce them to liquidate the long positions. So they are all nothing but the tricks. It is like a gambling den. They try to do the tricks again and again. So we should not get cheated again and again. There comes our smartness. Okay, if you've got any questions, you can ask me. I'll answer to those questions. These are all my contact details. And if you want any further questions to be answered, then you can just send me an email or just give a call or contact me through chat. I'll be able to help you out. If you've got the questions, please ask me because I've got time to answer to those questions. Another 4 minutes to go. 13:45, I have to wind up. Then Inni has got a question. May you please explain about the swing and the firm up move in your week forecast? See, swing and firm up is they just formed the new low, and afterwards they are expected to make the swing near the low. And sometimes they will make the swing near that of the high. See, here in the case of Aussie, they are making the swing near that of the high. That means about 10 to 15 pips near the high, they'll just make an upward move and the downward move, up and move and downward move. And if you're a smart trader, you can watch and see from that of 93.73, they will go up to 93.82 quickly. About 5 pips jump. And afterwards, in the platform, you will be able to see that. And afterwards, you will find pip by pip, they'll make a dip. So they quickly gain 5 pips, 7 pips. Okay, gained about 15 pips. Then afterwards, pip by pip, they will make a drop to the same level. That is called pump and dump move. So they pump up quickly without making much of a buy in the market and then start selling to the other traders who are willing to buy after the rise. So that is what they make a swing near that of the high. Sometimes what happens, they make the swing near that of the low, about 10 to 15 pips. Closer to that of the low, they make the swing. And sometimes between the low and the high, they make the swings. But swing is a one in which they don't breach the high or the low. That is a condition. Then afterwards, firm up means they should go above that of the high, or if they are making the lower level swing, then they will go slightly higher. That is swing and firm up. And swing and slide means they might be doing the swing near that of the high and then slowly come down. And all will happen within that high and the low. Then Imanshu, what is your target for USD CAD? Okay, normally I aim for about 45 pips in the first trade, and they are expected to go above that of 1.1045 by weekend, and that will be the weekend target. And once I keep stop at entry, once it makes about 25-30 pips profit, then I will wait for the weekend and try to book profit and trail the stop in a profit making position. If it is filled, and I will re-enter after watching the next day low. And near the low, I will try to take a buy position. So the targets are also given in the Asian Session Live Market Analysis webinar. And I show it on Mondays, the expected levels. So 1.1150, we should be able to see soon in the case of USD CAD. They will just reverse it in a big way. That is why they are doing a prolonged lower level consolidation. In Eric, will gold continue to rise until gold is expected to make the initial lower level swings around the 100, 1225 to 1255 area, and later on it is expected to gain more levels. But Euro and GBP are expected to make downward move in this month. That is a forecast. I have given it on Monday. If you listen to the recorded webinar, you will be able to get it. See, these are all nothing but the forecast derived from that of algorithm, and there is no guarantee that the market has to move as per the expectations of the forecast, but predominantly will come across the market will move in line with that of the expectations. Then do you advise to buy USD at current level? Yeah, you can buy with a hedge order. Always keep in mind that we can buy because they have not breached the low 102.22 for a long time. And so you can buy from the early European session. They are not breached it. You can buy. It is an extended move to make a rise again. Enjoy. For first 2 days, Euro went down and AUD went up. So now we can predict it will reverse. Yeah, that is what. This is how they handle it in order to make the moves in the case of the crosses, the commodity crosses like Euro CAD and Euro Aussie and things like that. In Pfizer, can you forecast that till what limit will AUD and AUD USD move? AUD is expected to reverse soon. And they are just making a high level consolidation with an upward stop in order to make a big downward move. Group 1. If market is Euro and GBP especially not making move more than 20-30 pips, should we avoid committing positions? Yeah, we have to avoid committing position if there is spread between the high and the low is less than 40 pips. If they increase the spread, then probably you can just watch during the early session what sort of moves they are doing it, and then commit positions so that by end of the session we'll be able to close. And if you're able to watch throughout the US session, then try to take the early part of the US session, the position. If you're able to watch throughout the European session, then early European take position, close it during late European. So that way, if you try to do the session-wise trade, you will not incur much of a risk. Okay. So no more questions. So I take this opportunity to thank FX for the facilities provided to present this monthly webinar and also the other webinars. And also thank you people who have come here to listen to my webinar. And if you are really benefited, I am very happy about it. And try to see that you are able to do fearless trades. My basic idea and the approach is to give the confidence for you and try to understand the players, how they are making the moves in the market, so that you will be able to get rid of the fear. If you are not able to understand, only then the surprise comes. Once you understand, the surprise is not there. So once you get rid of the surprise, you are able to read the market correctly. And that is my intention. So I'll come back on Monday and give the next Asian session live market analysis webinar for the next week. So thank you one and all. Enjoy trading and try to make sensible trades and try to control the emotions to become a professional trader. Thank you. Wish you all the best.